Welcome to this Killick Explains video, and in the current climate I want to revisit some messages that I have talked about before but which I think are particularly apt right now. So I'm going to talk about 7 tests for firms with what I call staying power, because the key when markets are volatile, when life is uncertain, is to look for those firms that have the ability to keep powering on even if their share prices take a bit of a dip in the short term. So these are undoubtedly tough times. I don't need really to reiterate why, but interest rates are on the rise as I make this video, summer 2022. The cost of living is rising all the time, and costs are rising for businesses and for individuals. Consumer confidence is lagging, is struggling. Growth is also struggling. So plenty going on the negative side, if you like. But a long-term investor will try and see through all that and look for what I call survivor stocks. And the question then becomes, what is a survivor stock? And I've grouped my answer into 2 categories. I've got 4 tests, which are financial tests, if you like, and then 3 more, which are operational. These are not in correct order. It's not like number 1 is more important than number 7. The 7 tests, 1 group of 4 financial, 1 group of 3 operational, then at the end, some further information sources as usual. So, on the financial side, my 4 tests, what am I going to look for? 1, profitability. And that, in a nutshell, I have been here before in other videos, means strong, persistent revenue generation and consistent profits. And profits can be measured a number of ways. One of my favourites is the gross profit number. Next one is the operating profit number. And then no harm in looking at the net result, which is what gives you the ability to pay dividends. But you're looking for a clarity around future orders and revenue and consistent profits. Next, stability. And stability I'd measure 1 of 2 ways: liquidity and solvency. Liquidity, ability to meet short-term obligations as they fall due. That's working capital management. This is a business that's got a grip on short-term receivables, short-term stock, if it's that kind of business, cash and short-term payables. And then solvency, ability to stay in business, if you like. This is a firm that matches long-term assets to long-term funding, short-term assets to short-term funding, and so on. It has the ability to draw on credit when it needs to do so, and it has a level of overall gearing which is sensible in the context of both the business and where we are in the cycle. Test 3, cash flow generation. This is a case of looking at the length of the operating cycle. That's the gap between money leaving the business and money coming back in again. If you are a food retailer, you may be in the happy position of actually operating a negative cycle, where you actually get cash from customers before you pay suppliers. But most businesses are in the opposite position. Watch out for that cycle starting to stretch or starting to get stressed. And then free cash flow. Really important that businesses can generate persistent, consistent free cash flow. They're turning operating profits into operating cash flow, and the free cash flow bit is what have they got available to meet dividend payments to investors. Fourthly, no hidden nasties. Now these can be difficult to spot. The directors obviously don't want you to spot them, but have a look towards the back of the financial statements. Rummage around in those notes that support the balance sheet for guarantees made to third parties, legal obligations, for example, which may not have been disclosed as a liability in the balance sheet. And basically a test, a rule of thumb, is the more that's written into the related parties note, the contingent liabilities note, obligations notes towards the back, the longer those notes are, the more nervous I would personally be. So those are the 4 financial tests. What about the 3 operational ones? Now these are a bit fluffier, but they're really important. Just because they're hard and you can't put a ratio on it doesn't mean you shouldn't think about it and you shouldn't do it. So number 1, is this a firm which is admired and trusted? In other words, does it have a solid, long-term, sustainable brand advantage? Have there been any recent scandals? Have there been any directors leaving under mysterious circumstances? All those things give you a bit of a picture, media coverage, sentiment around the firm, analyst coverage and so on. Number 6, or my second operational test, is it difficult to copy what this firm does? Warren Buffett talked about firms having a strong moat. In other words, is the product sticky? Are consumers loyal to it, or can they switch out at a moment's notice? Are there any regulatory hurdles which will stop people just storming into the market? Is first mover advantage a genuine advantage? And what stops people simply switching off the service? Netflix subscription start, for example. All of those are part of this test for the strength and the width of a firm's moat. And my final, test 7 overall, if you like, number 3 of my second set of tests, is it run by a strong team? Now, I'm a bit conventional here. I want to see experience. I want to see no gaps in senior positions. I want to see low turnover in those key senior positions, particularly as we go into a more difficult phase for the economy. It's not simply a case of opening a business, putting a dart on a dartboard, saying I'm the next crypto king and so on. There's more to it when it comes to running a good business than that. Now, those are my 7 tests. Just want to finish up on a key point. Does size matter? People say sort of, should I be sticking to big firms? In other words, what you're describing just the top firms in the S&P 500, the FTSE 100? No. You can basically find firms that hit all 7 criteria all across the size spectrum, big, medium, small. What I'm saying here is look for quality over quantity. In other words, no one is too big to fail, and plenty of firms have demonstrated that in the past. So it's not a case of simply locking in some of the biggest names in the market, because they'll also be the most expensive. If you think about it, there's a little bit more to it when it comes to building a portfolio than just that. Now, lots of tests, lots of ratios mentioned and so on. So where would you go for more information? Well, the usual places, killick.com/learn. And then you could go down here and look at the ratios tab. That might be a good place to start. The shares tab is another good one. If you want to read about some of this stuff in practical hands-on context, you could email me, editor@killick.com, for a copy of the latest Confidant, which I edit. That's the quarterly flagship magazine. And if you're just looking for some more sort of general meat around how to invest in equities, including some of the ratios I've hinted at briefly here, then there is a guide, fairly easy to read, fairly jargon-free, how to invest in equities, and that would be editor@killick.com too.